Hi, I'm Zach Miller. I help run business development for Covestor. I'm the first guest in an ongoing series that Covestor is hosting on investing. I hope there will be many more episodes. Thank you, Covestor, for having me on. I'm also the author of Trade Stream Your Way to Profits, How to Build a Killer Portfolio in the Age of Social Media, that was published last summer, and that's available on Amazon. I'm a professional investor by background, and I was invited on to talk about something that you might not expect, and that's insider trading. And I want to look at insider trading as a source of good information for you to learn about companies. And I'm going to do it in a way you're not typically accustomed to thinking about insider trading. So I'm going to do it in three parts. So first, I'm going to talk about the different types of insider trading, ranging from the illegal kind, which we're going to want to stay very far away from, to the legal type of insider trading, which I'm going to define. Next, I'm going to give you a model for how to do that. We're going to look at insider trading information and use that as a source of information for our own investment decisions. And then lastly, I'll point you in the direction where to find this type of information. So the overarching concept here is insider trading as a way to get valuable information on companies. So let's jump right in and talk about the types of insider trading. There's the illegal kind, starting with outright manipulation of stock prices, best exemplified by Daniel Drew, who was a railroad robber baron in the late 1800s. He was also a cow trader, and he said that playing the stock market was much like buying cows in the moonlight, and he had firsthand experience doing this. He would lead his cows, are they a flock, are they a gaggle, I don't know. He'd lead them to water in the middle of the night, have them drink profusely so that to inflate their size, and then in the morning sell them at an inflated price. He did the same thing with stocks as well and was convicted. That is outright illegal, and we're not going to want to do that. There's another type of insider trading which is illegal, which is receiving tips that are leaked from company, confidential information that will be impactful on stock prices. You're not allowed to trade on that. You're going to want to stay away from that. That's also what Martha Stewart got caught up in 2001. She sold $46,000 of a stock that she received on a tip from her broker, who also represented the CEO of that company who was selling his stock. She ultimately saved $46,000 in losses, but she saw her empire go down to $500 million of net worth, and she spent some time in jail. So you're going to want to stay away from that as well. We're going to talk about the legal kind of insider trading. So insiders, corporate insiders, are allowed to trade in their stock, and some people are not necessarily aware of that. They have to file publicly with the SEC when they do this. They also have to file with their compliance officers as well as the exchange that their stock is traded on. Professor Sehun, who's a finance professor at University of Michigan, wrote an interesting book called Investment Intelligence from Insider Trading, where he looks at insider trading data. And much of what I'm going to talk about now is just defining his model. He found that insiders are incredibly good traders, and he asks why, and he credits the value of the information that they have access to. So he creates what's called an informational model, and he distinguishes the types of insiders by the value of the information they possess. So at the lowest level, you have large shareholders. These are hedge funds and mutual funds that technically know more about the company than we do, other than what management will tell them or the research that they do. But they're outsiders, essentially. They have the least valuable information, and when you look at their trades in the aggregate over the long term, they do beat the market, but not by much. The next level up is directors. These are actually a catch-all phrase that he uses for anybody that's not in the other three cases. Next up in the pecking order are the officers. These are less senior employees of the firm. These are like director and VP level people. They're not necessarily sitting on the pulse of the firm because they don't have that senior perch, but they are definitely involved in the day-to-day running of their company. They have good information, but not the best. The people who have the best access to information are senior management. These are C-level managers, senior vice presidents. These are CFOs. These are people that really are sitting on and have their finger on the pulse of the company and possess the most valuable information. If you looked in the aggregate of all these four types of shareholders and all their transactions over time, they would beat the market by 3.5% per year. That's an incredible amount if you look at that compounding. What Professor Sehun says, you can better your investing by looking at the types of insiders that have more valuable information, so the officers or senior management. We'll talk about some of the strategies right now of how Professor Sehun recommends bettering your performance by tracking some of these insider trading data. So the first thing is to look at active versus passive buys. A lot of times when you look through the data of insider trading, you'll find that that insiders are incrementally adding to a position. That's sort of a more passive role. If you see, and they may do that month after month or quarter after quarter, you'll see a pattern in either the buying or the selling. what we want to look for is something that is erratic, something that comes in and is different than what we've seen before. And mostly we're going to look on the buys versus the sells. People sell for all types of reasons. Maybe they have to pay off a mortgage. Maybe they have to make a wedding for one of their kids or send their kids to college. When they buy and they reach into their own pockets, this is their own money that they're putting to use in their own company's stock. That's going to be very telling. So we're going to look at the buys. We also want to look at what Sehun calls clustering and consensus. Clustering are when we see many different buys or sells occur at the same time. And consensus is when they're all in the same direction. They're all buys or they're all sells. So that's going to be more telling. And this type of information following insider trading it seems to work better when you look at mid-cap and smaller cap companies. It's not so telling when the CEO of a large company comes in and buys his company's stock. We're also going to look at, obviously size. We want to look at, and size does matter here. We're going to want to look at big sells or big buys, right? And he generally defines that, Professor Sehun does, as over $50,000. Obviously, the sky's the limit there. If somebody's going to come in and put a few million down on their company stock, that's something that's noteworthy. So lastly, where do we get this type of information? So a lot of this is available just in general financial portals, the Yahoo Finance, the Google Finances. If you're looking at an individual stock, you can go into the left sidebar on Yahoo Finance, and there'll be an insider trading tab where you get information, a calendar of who's been buying and who's been selling. You can mock that up to really find a pattern or any divergence from certain patterns to help us find those stocks. There's some stock screeners as well that will allow you to subscribe or for free to access just daily information, who's buying, who's selling, what stocks are seeing the most information, most type of insider trading transactions. It's important, again, and Professor Sehun says this as well, is to distinguish the types of trades, right? So corporate insiders are allowed to sell sometimes. There's certain windows where, obviously, leading up to earnings seasons, they're going to be locked down. They're not going to be able to trade. There's a legal structure called a 10b5-1 plan that allows them to sort of automate their selling and buying activity. That means that they won't be able to buy or sell during those windows on their own, but they can actually automate it so that they can sell 10,000 shares every month. There's no informational value in a 10b5-1 plan. We want to see any divergence from that plan. So hopefully I've shed some light on some interesting aspects of insider trading for you. Hope it's given you a new approach, and I hope it's help you generate some ideas for your own investing. Thanks for having me on.